um, to our past president, Shri Nilesh Shivji Vikamsi ji, to Dr. Neeraj Gupta from the Indian Institute of Corporate Affairs, to CA Durgesh Kabraji, the Vice Chairperson of the Corporate Laws and the Corporate Governance Committee of ICAI, and Sarika Singhal, CA Sarika Singhal, the Secretary of the Committee, and to all the wonderful ladies and gentlemen, chartered accountants who've joined us today for the third edition of MANTHAN. MANTHAN is a series of webinars that are promoted by the Corporate Laws Committee of the Institute of Chartered Accountants of India, primarily to present new and varied perspectives on aspects related to corporate laws and governance. We had a choice, of course, the whole universe belongs to, a corporate law domain. So we could pick any topic and speak about it. But Durgesh Bhai and I sort of decided that we would do a lot more on corporate governance, because we keep reading about corporate laws and interest and deposits and, Schedule 3 and CARO all the time. So these are intended to be a slightly different series of programs. And in that sense, the kind of connect we want to have with our stakeholders is also sort of broader and wider. It's not just intended for the chartered accountants in practice, but it's also intended for the members in industry who would either be members of the boards themselves or members who support board roles. And since these are open webinars, we also get a fairly large number of people who are connected to corporates, but not necessarily chartered accountants. And in this particular edition of MANTHAN, we bring to you board of directors and how do you actually enable oversight. We have with us two very eminent speakers who will lead these discussions in the first part. We have Dr. Neeraj Gupta, who's going to talk to us about the institution of directors. Followed by that, we'd have CA Nilesh Vikamsi ji, who has tremendous experience, not just tremendous, but I think exemplary experience, having served on boards of very large and listed companies. So he will present some very practical issues on the current topic of the day, which is enabling oversight for boards. And then there would be a presentation, a joint presentation, a first of its kind, anchored by both Sri Durgesh and me. We've actually sat together and tried to put together a PowerPoint presentation where we've sort of said, okay, let's take a case study of a company, which is a large but not listed company. We'll do listed as a separate series. So what are the crucial elements? What are the 50? What are the 75? What are the 100 building blocks of board oversight? And this is where we also feel there is a very large role for the chartered accountant fraternity to actually enable building the blocks of building a toolkit for oversight for boards. India is a very diverse country, and so is the corporate space. You have really small companies, which ideally shouldn't have been companies at all. They're very proprietary. So you have the small and medium companies, and then you have large companies, you have public companies, private companies, listed companies, all with varying thresholds of loans, deposits, turnover, etc., and all coming under different ambits of compliances under the Companies Act. So we felt, but largely our experience has been that the boards can certainly be more empowered in terms of their capability to exercise oversight over the companies that they run as the board, or even in terms of investee entities of the companies. So that's broadly the theme of the presentation. And I take great privilege in introducing CA Nilesh Vikamsi. He's a person of so let me actually not step off the script. Nilesh Bhai was my president in my first term in the council, so I know him well. And I'd just like to take the liberty of, and to take it a bit personal, to say that he's one of the best people I've come across. A man who can sort of hold out on his own, and who did some terrific work in putting ICAI on a much higher pedestal than where we were. a person of very high professional vigor, integrity, and technical expertise. Nilesh Bhai was elected as the president of the Institute of Chartered Accountants of India by the 23rd Council for the term 2017-18. He's been very, very selfless, and we've seen him at it. A very down-to-earth person. And he's sort of bestowed with a very natural kind of prudence, organizational, and leadership skills. He had a very, very nice ability to carry the entire council along. Not a small task by itself. And he handles professional audits and consulting engagements of large nationalized banks, foreign banks, large listed private and public companies and private limited companies, mutual funds, financial services companies, etc. And hence, not only does he know audit and business advisory, but he also does it for companies which are across domains. So a fairly domain agnostic professional, if I may. He's been, in his tenure as the president, I think he was a key proponent of being able to put the Indian accounting profession on the global map. And he's passionately represented the profession. I mean, and I'm sure you'd see multiple videos of Nilesh Bhai in several global meetings and conferences. He has a pretty smart global outlook and vision, which is pretty much needed because I think, as Thomas Friedman said, this is a flat world, and so must the accounting profession be. It has to be a flat profession that transcends borders. And he's also been a part of the SAFA, and which is the South Asian Federation of Accountants. And what is the most exciting part about Nilesh Bhai being here today is that he's presently associated with many companies and is a director with Navneet, All Cargo Logistics, Gati, Thomas Cook, PNB Housing, IIFL Finance, 360, Gati Kintetsu, SOTC Travel Services Private Limited, Nippon, India Infoline Finance Limited, etc. And ladies and gentlemen, may I kindly request you, in addition to it, what I again found particularly fascinating is he's a practitioner of Vipassana. He's told us many times that we should get into this because he always feels that, you need to be well-rounded, and it helps him to maintain his work-life balance. And over to Nilesh Bhai, and may I kindly request you to please put your virtual hands together to welcome Nilesh Bhai.
Thank you, Shripriya. I think first Neeraj ji is going off the block, right?
Sure. So I'll finish the introductions of Neeraj ji as well. I also take this opportunity.
Thanks a lot for a very, very kind introduction. Thank you.
Our pleasure, Nilesh ji. Dr. Neeraj Gupta presently heads the School of Corporate Governance and Public Policy, the Indian Institute of Corporate Affairs, which is attached to the Ministry of Corporate Affairs. He also leads the public policy initiatives on the Independent Directors Data Bank and the National CSR Awards as a nodal officer. He has more than 27 years, which is a little more than most of our professional practices, I guess, in research, teaching, and consulting. He's a PhD, an MBA, an MCom, and a postgraduate diploma in financial management. And he's actually attended quite a few programs in institutes of repute, such as the IIM Ahmedabad, IIT Kanpur, MDI Gurgaon, etc. He's also a visiting research fellow of ICSSR, a DEA fellow of the Foundation Maison des Sciences, which is in Paris, France, on the aspects of corporate governance, business sustainability, and responsible business conduct. He's also been a visiting professor to a number of academic institutions in India and Europe. He's engaged in various research projects, authored a number of research papers, reports, etc. He's participated in various national and international conferences in academic, consultancy, and advocacy forums. We've heard him speak before, and we thought we must bring him to you. Executive training and adult learning are his forte, and I'm sure he'll also help us to unlearn and relearn a little bit. And he's trained a number of boards and board members of public and private sector companies in India and abroad. So once again, a virtual welcome, a virtual applause and a welcome to Dr. Neeraj Gupta. We're very, very privileged, honored, and delighted to have both Nilesh Bhai and Nilesh Ji and Neeraj Ji in this forum here today. And so it's over to Dr. Neeraj Gupta for his address on the institution of directors. Over to you, sir.
Thank you, Shri Priya ji. Is my voice audible?
Yes, sir, you are.
Okay. So thank you, Shri Priya ji, and many more congratulations and best wishes to the Corporate Law and Corporate Governance Committee of Institute of Chartered Accountants. And it's delighted to be part of this amidst expert. I'm still a novice and trying to learn Nilesh Bhai and Kabra Sahab. Thanks for inviting me. So the topic which you have assigned to me, the institution of directors, I'm sure we have a number of directors presently attending to this seminar. It's a very good initiative. What I would like to say, it's the human capital which really matters, especially in the shifting times when the assets, especially the knowledge assets, are becoming of paramount importance. Companies had been created with brick and mortar, given life by the humans. And in present day environment, when the entire ecosystem is taking its stride and shifting in leaps and bounds every day, in, day out, especially after the COVID pandemic, when it has challenged the business models with which companies were operating, and now shifting their gears to have a shift in their business models, means and ways to do the business. What comes to the center stage is the knowledge asset, and the real drivers of this is humans, and directors fraternity is one of them. So what I believe, if we think in terms of good corporate governance practices, exceptional board governance practices, the roles and responsibilities of directors are the most important element which comes to the spotlight. The two traditional aspects which we had been talking since the advent of corporate governance as a separate discipline, that is the duty of care and duty of loyalty, which means to say that the directors are supposed to be careful about their fiduciary responsibilities, and at the same time should stand loyal to the company they are serving, towards the interest of the company as well as to the interest of all those who have contributed in bringing the company to life, is something which is of course sounding traditional, but yet stands relevant for the entire director fraternity. And when I talk in terms of institution of directors, if we really focus on these two, I believe major aspects or major pillars of good corporate governance, good board governance stands answered. So we as chartered accountants, I'm sure in this seminar, all of the participants are chartered accountants, have a larger responsibilities in whatever capacities we are associated with the companies. Of course, if we are directors or we are aspiring directors, or we are associated with the board practices as the chief financial officer, or we are advisor to the board on various financial matters, what becomes important for us to keep focus on these two aspects, duty of care and duty of liability, which helps us stand different from others, because in that way we'll be able to contribute more to the board for securing the interest of the company, contributing towards its growth, sustainability, etc., etc. Having it as a focus at Ministry of Corporate Affairs level, it had been a long-standing thought of focusing on regulations where the director should be recognized as one of the key managerial personnel who can really drive the change within the boards, and hence the regulations should be befitting for the current Indian context. One key trend which we have observed at the level of regulator is the shifting, regulations as far as the roles, responsibilities, liabilities, and the rights of the directors are concerned. There are many initiatives which have been taken. The regulations in the country again is in tune with the global, canvas and shifting every bit. And now, both at the level of ministry as well as at the level of Security Exchange Board of India, specifically for the listed companies. Yet at the same time, there had been steps I'm sure many of you must have followed when various actions and various steps have been taken for protecting the interests of directors so that they could freely contribute. So one aspect which in terms of institution of directors, I have already mentioned the traditional roles of duty of care and duty of liability they have to follow. But at the same time, they should also look at other aspects, best practices, key trends which are evolving so that they stand contemporary and they become more contributory to the board. But one thing which I would like to focus, especially for those who are sitting in the boards, that India is not an exception to the global trends, and we should really be aware about the fast changing regulatory environment. And in many cases, especially after 2013, when the code for corporate governance has been revisited and a fresh look has been provided, many regulations have changed quite in a fast manner. And I must say, in very simple terms, like we have tried to create a new wave and dust even when the existing one has not settled down and people have not assimilated it as far as its consumption or its practice is concerned. So one thing which is very important for the present day institution of director is to keep pace with the changes which are taking place in the regulations, because what becomes important in wake of having high level performance is to attend to the requirements of compliances first and then going beyond and looking at good corporate governance. So that's one aspect I would like to focus, which is a very important aspect for the institution of directors, that the newer codes which have taken place in India, and especially the codes which helps us having a focus on the best practices by looking around other jurisdictions also, is quite an important thing. One more point I would like to add here, as far as the shifting regulatory frameworks are concerned. Of course, India is a nation where directors work under the rule-based regime. We have still subscribed to the principle-based approach, especially when India works on ethics and principles. So at the same time, when we look at the shifting regulatory frameworks, we should also give focus to the voluntary frameworks which have emerged, and especially when today the whole world is talking about a new framework of ESG, means ESG based corporate governance. The voluntary codes which have emerged, especially in 2019, in the form of national guidelines on responsible business conduct, which is nothing but a confluence of different possible standards which had been followed. Either we talk in terms of GRI or SASB, or we talk of integrated reporting. Of course, there is an advent of international sustainability standards board, which has consumed and assimilated all different frameworks and is coming up with a new set of framework, is something which is very important to focus. Of course, that has not yet find place on mandatory basis in India. Another aspect which I would like to focus is the mechanisms by which the regulations are enforced again are becoming more stricter and more tighter. And the usage of technology, usage of data analytics, business analytics is something which has made it much more simpler. So if you will look at the past trends and practices when enforcements were weak, simply because of the reason that the compliance levels and compliance mechanisms were in a different shape, is not the story today. Business analytics, and especially if we refer to the present budget speech of Madam Nirmala Sitharaman, we would find that newer centers giving better analytics in terms of level of compliances and level of enforcement, so that it could be worked as a better assurance service from the side of regulators to those who are doing good practices, and penalties and prosecutions to those who are engaged with bad practices, is something which is going to change the face of corporate governance in India. So directors, the company's secretarial departments, the corporate boards, in general need to be more diligent on this aspect, that enforcements are getting tightened. So whatever we are signing, whatever we are disclosing, whatever we are submitting to the regulator is something which again has gained enough spotlight of the institution of directors and needs to be given due concern. On the one hand, from the regulatory point of view, the enforcements have tightened up, but it has created an opportunity where directors themselves are more cautious these days, more diligent these days in terms of looking at what they are being served with along with the agenda papers, and what information they are being provided as far as various decision making practices are concerned. So that's another aspect which is very important for institution of directors, and we all are needed to given a due concern of it. The third major aspect, which is important from the director's point of view, is understanding their liabilities and understanding their focus on the purpose of a corporation. Dear friends, here I would like to mention that it is always a purpose which acts as a mother as far as creation of a company is concerned, but especially the conglomerates, especially the companies which are operating since decades or maybe from centuries. What becomes important at times is a focus on short term or focus on the immediate challenges, opportunities, and requirements. And many a times we deviate from the corporate purpose. Institution of directors are served with a greater opportunity to visit and revisit the corporate purpose within the board meetings as part of their roles, so that the company could be kept focused on the key aspects for which the company has been created. That's part A. As part B, having a focused discussion and deliberation on these aspects also strengthens and supports the board in communicating it to the various set of stakeholders, not just confined to the investors or shareholders of the company. So directors have a very important role in bringing the company back to the focus on the core purpose for which it has been created. I would like to quote here a number of research studies conducted. I would refer a study which has been conducted by International Consulting Organization, which is based on Hong Kong, on a set of companies from the entire Asia, looking at how well they are focused on their corporate purpose still for which they have been created, and to what extent they are communicating it. And they divided the entire study by putting various objectives in different buckets. And I'm not very very much surprised. Of course I was when I was reading this report, but I'm not very much surprised or shocked to share that hardly 15% companies regularly discuss the corporate purpose within the board, and tries to look at the means and ways by which it is communicated to various stakeholder groups. Whereas as part of study, it was concluded that having it well defined and well communicated is something which not just adds to the reputational value, but also keep the company focused. So this is the third aspect which I would like to focus. The fourth aspect, the fourth key role or key responsibility I would like to mention, which of course is a part of a global trend, is to look at diversity, equity, and inclusion within the board. When I say diversity, equity, and inclusion, I would like to broadly categorize it to two aspects. Diversity as far as the gender diversity is concerned, and we all must have followed how Companies Act and SEBI regulations talks about ensuring greater participation of women leadership within the board. Of course, there are some contrastful studies also available which does not appreciate or recognize that it makes a difference towards the performance of the firm, yet largely it adds up to the better dynamics, having better dynamics, better inclusive and participatory approach within the boards. So a part is ensuring more gender diversity within the boards, and the B part again is equally important, which talks about having skill-based diversity in the boards. So it is the role of each and every director, especially those who sits in nomination and remuneration committee of the board, to voice this aspect that we should have more diverse boards in terms of skill sets, so that each and every strategic aspect which comes to the table of board could be discussed from 360, and a more futuristic, a more beneficial, a more rewarding, returnful decision could be taken. So that's the second aspect which is important, and giving voice to this, having appreciations of this. I'm sure you would recall that SEBI in 2019 released a circular that every listed company board has to submit a detailed disclosure to Security Exchange Board of India in terms of composition of the board and relative skills and expertise which each and every director brings to the board. So that's something very important. One message which I would like to convey here for each and every director is, of course, we come from diverse backgrounds. Everybody may not be chartered accountant. Everybody may not be a technocrat. Everybody may not be a management expert, and so on and so forth. Yet, when we talk in terms of diverse skill set of the board, the directors should also try to enhance their capabilities towards the newer aspects where they have an appetite to learn. And that is the reason there are many classical aspects, especially having understanding of the finance, which is considered to be very important for each and every director. No matter you have a formal qualification of finance to your credit or not, you are a chartered accountant or not, you sit in the audit committee or not, but yet having focus on financial aspects alongside all other non-financial aspects is again something very critical, which is expected as a skill from each and every director. So directors should focus and voice for more diverse board, and at the same time should try to inculcate and develop at least one more skill, taking a diversified approach in an area where they have an appetite to learn further and to contribute further, so that the contribution level could increase in the boards. Then another aspect which is important for the institution of directors to remain focused on the key functions of the board. I understand that within the board, the agenda is a mix of a variety of items, some for conformance, means confirmation, some are routine items, and others pertains to strategy, long-term vision, aspects relating to deliberations on possible means and ways of value creation, and also associated with the key responsibilities of the corporate for various stakeholders group. If I divide into two, the stakeholder group who comes from the investor side, and stakeholder groups who comes from the non-investor side, including the employees. So it's a larger responsibility of the institution of directors to remain focused on this and to strive at every time to spend more and more time on strategy, value creation, corporate responsibilities, and also the risk management. And especially this pandemic thing has attached a big value to the risk aspect. Of course, concepts like, you are chartered accountants, you must have studied the concept of value at risk, and you must be calculating value at risk for various decisions which comes to your table. But risk per se was not at the forefront of discussions in the Indian boards in last 10 years. Then the pandemic broke up. But today we have started talking more on risk. So as an institution of directors, we can strengthen the board practices by having focus on such aspects which not only enhance the quality of discussions within the board, but will also provide an opportunity to the board to contribute for the long term growth of the company by taking a long term view of different aspects. What I see with my interactions with various sets of directors who sit in public sector boards or private sector boards, we find that a majority of time the boards are not discussing this. Boards are discussing either what the chairman wants or what the regular routine items are, leaving them aside, denoting lesser time for these discussions. Whereas if we look at the global level trends, the boards are more discussing strategy, risk, and possible trends within the industry or across the industry, within the country and across the jurisdictions, so that more and more value could be created for the stakeholder groups. Another trend, probably the sixth one, which I would like to talk, is data. Directors have a larger responsibility. It had been, there are many phrases where which we hear almost every time, especially when the social media is so popular. We all are on professional social media platforms such as LinkedIn and all, and otherwise also on WhatsApp University. There are so many forwards and so many interesting information which is flowing from one hand to another. What becomes pertinent is to trust data other than the God. So any information, any discussion, any kind of perspective, any kind of alternative as a means of solving a challenge which the company faces, what is in trend is to look at the data and having reliability of data. So what I stress upon here from the institution of directors is to develop perspectives based on data by analyzing it in a manner, or by asking the team members or the specialists to analyze for the generation of the suitable information, which gives some better insights to arrive at a better decisions. So what becomes a challenge is not the dearth of information or dearth of data, but what is important as a factor for the institution of directors is to have proper skills and perspectives, mindsets for governing the information data in a right manner, so that it could be put to use in a manner which is more productive and more productive and fruitful. That's another aspects. The time is very short, 20 minutes have been given, so I can just touch upon and sensitize you towards the aspects so that you can further read, deliberate and discuss. Another aspect, the seventh aspect, which I would like to focus upon, is towards accountability and transparency. So we should focus as the institution of directors within the board to develop more ownership so that we stand accountable and we develop a culture within the organization to be more transparent. When I talk about accountability, means having realizations of the responsibilities and having the courage to accept what we are doing and how we are doing, with what perspectives and with what vision or purpose we are doing something. And in case we do something which doesn't turns out to be in benefit of the company, we should take the accountability, and accordingly the suitable action needs to be taken. Accountability is not just required on the part of the board, but also on the part of C-suite and other managerial executives who work in the company. That's the reason I'm weaving it with the aspect of culture, not as the aspect of regulatory requirement or as the aspect of compliance, or to stand accountable just for the sake of saying we are accountable. Another aspect is transparency, which again is a part of the culture of the organization. How much transparent we are within the company, including the board, and how much transparent we are as far as our affairs are concerned for their reporting to the annual general meetings and also the stakeholder groups. Of course, the concept of materiality has to be taken care of, and due diligence needs to be taken as to what needs to be disclosed or what needs to be reported, what needs to come in the public domain. Yet a conscious decision with a culture of transparency is something which not just strengthens the quality of board governance, but also enhances in terms of reputational capital of the organization. The last aspect which I would like to stress upon, and then I would like to rest, is the upcoming concept of ESG based governance of the company. People read it as environment, social concerns, and governance thing. Friends, I read it in a reverse order. What I believe is, when the corporate governance emerged as a separate discipline, we focused more on governance aspects, governance frameworks, governance-based regulations, and then gradually, the industry trends as well as the regulatory frameworks have brought our focus to the S aspect, the social concerns and the social responsibilities. Section 135 is not an exception to this. And lastly, now we have having realizations of climate risk and climate change, and have started talking about environment, how sustainability is important, how business value chains and practices needs to be aligned in a manner so that we focus on more environment conservation, environment protection, and also promotion on sustainable means and ways of doing business, so that we could save the mother earth. It is a newer concept, of course. Institute of Chartered Accountants, I have spoken previously on the platform of Institute of Chartered Accountants of India, which have taken a lead of conducting series on ESG for the boardroom practices across. Mr. Sanjeev Singhal had been very, very instrumental on these aspects. He heads the Sustainability Standards Board as well. Of course, your institution is the one which is going to show us the I would say is the torchbearer institution, setting up standards how chartered accountants don't just focus on the numbers of profitabilities, but at the same time focus on means, on ways by which the profits are coming, whether they are truly sustainable profits or not. So this again is not just a responsibility of directors, but the entire chartered accountants or finance professionals fraternity, where they have to focus on these aspects and have, what I see, CFOs have a larger role in this, along with directors and the boards, because ultimately what could drive such sustainable measures is a big shift in processes, which requires a lot of new R&D, new innovative means and ways, new technology. Of course, a lot of capex may also be involved for that purpose. The financial advisors and financial practitioners are often concerned about the break-even time and the time in which the companies could recoup these additional investments to stand more sustainable or eco-friendly is something. But what is required is more capacity building on these aspects so that we could focus on finances and also the means and ways to stand more sustainable. This could only be the way to contribute better. Directors have a larger responsibilities, and if I precisely talk about the institution of directors, what at the first level is required within the boards is to have one perspective relating to environment and sustainability for each and every strategic decision. Either it is a blue ocean strategy of entering into a new market or developing a new product or any sort of changes in the existing product. Either it is a manufactured product or a service industry product. Either it could be managing by any means the customer centric capital is what we need to have a shift in the mindset of the entire board. Then only this will take a center stage. I'm sure if it will find a mind share, the discussion qualities will change, the perspectives will come as fresh perspectives, and board will deliberate more on ESG aspects just by filling up some tables which the BRSR contains for a certain set of companies is not going to change the face of the nation, which has close to 20 lakh companies operational within the companies. Just registering some changes in the first phase in 1,000, of course, can make a mark, but not a major shift from what we are doing and what we ought to do. So mindset changes at the level of large companies, listed companies, mid-cap, unlisted companies, small cap companies is something which can bring in small changes, and collectively it can make a big difference. So these 7-8 key roles, as far as key trends I see, very important for the institution of directors. And as a director individually, if we take a pledge to having focus on this, definitely gradual shifts will come which will give way to major changes. So with this, I would like to rest my discourse here and open for any questions. Thank you so much.
Thank you very, very much, Neeraj, on touching on some very nice and important aspects. In fact, when this Companies Act 2013 came, it ceased to be just a noun or a book. It stood for just 3 adjectives, which was accountability, A, C for corporate trusteeship, and T for transparency. And the entire act only spoke these 3 very relevant stories, and the boards as fiduciaries are expected to deliver this for the stakeholders. And thank you so much for touching on digitization, diversity, disruption, duties of directors, how boards are changing to obviously need to change to more strategic roles. I think that's what they were always intended for. Risk and compliance was basically the C-suite and at some level. So it has to be more of strategy and risk and compliance management. The relevance and the need to make data-driven decisions, and especially in the context that we have so much data around us today. So you can't but help making, wanting to do data-driven decisions, accountability, transparency, with that, the aspects of materiality, ESG, blue ocean strategies. Thank you very, very much here today. And now I'd like to, and we look forward to more sessions with you in the future. And it's over to Nilesh ji now. And with his wealth of experience in being a director of several large corporates, we requested Nilesh ji to share some extremely practical insights and situations on what exactly happens in these boards, what are the challenges, etc. And in this, there's a key learning for us. A, as chartered accountants or as auditors, can we gauge something that will make our own tasks and engagements better? And 2, can we advise boards of directors, taking inputs from Nilesh ji's speech on how we can actually make boards more effective? And the title of this seminar was actually Board Oversight, Value Addition by Chartered Accountants. And that's where he comes in. So over to Nilesh.
Thank you, Shripriya. I want to first of all thank the Corporate Law and Corporate Governance Committee for inviting me to share my, I would say, views and experience on this very important MANTHAN series which we have started, on the topic of board oversight, building blocks, value addition by CAs. So I'm really indeed, it's a pleasure. And so thanks to you, to Durgesh Bhai, Sarika for inviting me. And my task has been made simpler by Dr. Neeraj Gupta. He's laid the foundation of the 8 key roles and trends with the institution of directors or the directors are supposed to do. So that was, if I can say, is the foundation. And based on that, what I'm going to do is share my practical experience on being boards for almost like now 18 years, if I can say so. And the key, aspects where I think we as chartered accountants can play a very, very active role, either as a director or as an advisor. And friends, don't take the view, whatever I share, what the perspective of mine or my co-directors at that point of time, would be absolutely right. But there's only one perspective. There could have been different views or different, sort of approaches to a particular issue. But I want to share what happened in that particular case and how we sort of move around. There could be other perspectives also. And as Dr. Gupta mentioned and as Shripriya mentioned, our 2013 Act, I think, that regulation and the subsequent regulation today, our institution of independent directors, I would say the role, responsibilities, duties, and the expectations are absolutely clearly laid down. I think it's one of the best in class in the world. All the best practices of the world have been taken in the Act and in the various Companies Act as well as on the SEBI, I would say, LODR. Having said that, friends, I believe that we as chartered accountants are, tuned to be one of the best contributory as a director. I think the type of training which we have got, the type of understanding which we have of businesses as auditors, as advisors, I think puts us in a very, very unique role. Having said that, friends, the independent director's role is it's a tightrope walk. It's it doesn't have to be a day-to-day management role, but at the same time guiding, directing the management on a certain direction. In my experience, I have seen there are 3 different types of I would say entities. One is where the promoters are very dominant, shareholding wise and otherwise. So maybe more than 60-70% owned by the promoters. So there's a different sort of contribution levels. There are certain entities where there are promoters, but there may be say holding 20-30%, supported by some other investors, etc. So there the contribution levels are different. And there's a third type of entity which I have been used to is where there are no promoters, there are no shareholders at all. And it's a board managed, I would say, entity. So in all the 3, I would say the degree of the role and responsibility varies. It's not one, solution fits all. So depending on where you are, and our role is more of oversight rather than day-to-day management, as in more of guiding and not policing as an independent director. I think what our role is, before we do the practical examples, I think we can contribute a lot on the various different strategic options which are brought to the board on different matters and the direct therein. We can contribute on the risk management and mitigation. We may not be experts of all, but as chartered accountants, we have got that ability, an all-round ability. We may be an expert in either an audit or a tax or an indirect tax or whatever else, finance. But I think our ability to contribute in different areas is tremendous. Internal controls, cyber security or data analysis, as was being mentioned, regulatory compliance, I think we can definitely drive it towards it. Today, and in fact, friends, today without proper regulatory compliance, I think no company can move ahead. Earlier times, one could get away, I would say, with a little bit of non-compliances, but now the way the various rules, regulations, laws are on compliance, there has to be a zero tolerance. And I think we as chartered accountants can drive that, very well. There are some situations there could be crisis in the company also. There also our role as chartered accountants, our background as chartered accountants can add value in those particular crises. And I'll narrate some experiences. One area I think where, to my experience and possibly experience of the whole Indian, I would say, corporate side, where I think a lot more needs to be done is on succession planning. Somehow this is one area where, though a lot of work is happening, I think much more needs to be done in each company, whether it's promoter-driven companies or non-promoter-driven companies. I think succession planning is one area where I think the focus of the board has to be much more. ESG, Dr. Neeraj Gupta mentioned, I think now the current focus is there. Merger acquisitions, if some proposals come up, I think we again as chartered accountants can add a lot of value. And certain things which I think I want to warn you at this juncture, friends, is if you're if you're trying to become directors of public companies, be very careful today. The insider trading norms, the UPSI, the unpublished price sensitive information. I think this area SEBI is focusing, it's evolving. The way the amount of review which SEBI is doing is tremendous. And one may have not done anything wrong, may not have shared any information, but one has to go through the grind, assuming there are some suspicions or doubts of, the UPSI being misused. So be ready for that. Also, as an independent director, again, I'm very sorry to state that our Indian legal system has still not come out very, despite number of case laws, which says that the independent directors are not responsible for the day-to-day management and the action should not be taken against them unless they are, involved. But I have seen number of civil and criminal cases being filed against, independent directors. And that is one area I think I would plead, even Shri Priya and the Corporate Law Committee, how do we take it up with the Ministry of Corporate Affairs? And I think how do we communicate to the judiciary the roles of independent directors and that they should not be, how the independent director's role has to be viewed. And this frivolous litigation, on maybe there's a customer complaint and independent director also is hauled up. I think that's not done. I would also recommend to you to have a look at the directors and officers indemnity policy. If you're becoming a director, please have a good coverage yourself. And I think all of us agree that the knowledge of business, industry, financial statements and law always help us. So we as chartered accountants, in fact, just to reiterate, are very well placed. With this, I'll go into my practical experience, what I have seen. Friends, the first company where I was requested to join the board company which was going to go listed, that was way back in 2005. And the promoters came to me that we want you to be as a director. And what I saw in that company was basically those two promoters were, doing almost everything. One of them was a CA and MBA, another gentleman was a IIT engineer and as well as an MBA. And right from, accounts, marketing, strategy, whatever, IT, everything was handled by them. So one of the questions I asked them is, are you going to run the company throughout or you're going to professionalize, whether you're going to have a HR head or a marketing head or a CFO. That time they didn't have a CFO. And they agreed. And only then I joined with them. And of course, I don't want to name the company, but I'm very happy that I joined them and they become a conglomerate, a financial services conglomerate later on. And one of the incidences which again came over there a few years down the line is there was a proposal which came for taking a team for a foreign institutional, setup for institutional equities. And the proposal came to the board to pay 44. This I'm talking of, friends, about 10 to 15 years back, not recently. 44 crore sign-on bonus for taking a team of 4 people. And what we at that time in the board we saw is 44 crore was a P&L debit. But at the same time, the same team was investing 44 crore into the company for paying 10% of the, warrants were being issued to them. And they were paying the 10%, advance money for the warrant. So they were taking 44 crore. 1/3 would have gone in tax and whatever the tax rate was then. But at the same time, they're investing 44 crore. They are putting their skin in the game. So it was a P&L charge for the company, but at the same time, a capital receipt. And they were willing to bet on the company's growth. Such a huge amount at that point of time. So that was one of the factors which the board at that point of time considered, though it was a P&L hit, but the interest of the company itself, the team which is joining is putting their skin in the game by, investing after paying tax. So that was one of the decisions which was there. One other area in this same company, as we grew, apart from initially they went into broking, they went into a non-banking finance company as a separate company. In the NBFC, they started, apart from other activities, was commercial vehicle lending. So initially, first year, there was a trial and error. There were some losses because they were still learning the ropes of the trade, the control system which were required. And they put that in place. We had a credit audit at the board level, which we saw to it that the things are streamlined. And that particular area, commercial vehicle loan business, was doing well. After a couple of years of doing well, in one of the quarters or 1 or 2 quarters, consistently, we saw that the NPA levels are going up. And the board just informed the promoters that it appears that the NPAs are going up. Why don't we look at the specific viability with this level of NPA that's viable? The promoters were very smart. And I think before the next quarter, that business was sold to another NBFC, and they made a very neat, clean profit thereon. One other area of where this company was doing as an NBFC, apart from broking, was the lending to real estate builders. Apart from, and what they used to do is they used to say lend an X amount, say 500 crore. They used to keep 125 crores on their own book, and balance was downsold to the wealth clients or to the clients. So as directors, we were warning them, and at very huge rates of interest, 21, 22% interest plus maybe processing fee, etc., etc. Good business for them. But we sort of, the board advised them two things. One is, why don't you sort of inform the investors who are investing also that there could be liquidity risk. In real estate, there could be 2x, 3x security, but there are possibilities of the project getting stuck if the approvals are not there. And they did used to warn their HNI investors, and we didn't get any complaints as and when some project was stuck, the repayments are not coming in time as far as those debentures or whatever is concerned. More importantly, these people were early in the block, and after some time, again, the board warned them that this appears to be a very, very, the way the Indian industry was moving, the real estate side, it's going to be challenges down the line. And then we saw some new companies coming out, NBFCs, and acquiring this company loans at lower rates. Assuming you're given at 28%, they came in and stepped in and started lending at 18%, 17%, 16%. And they booked, and the board had warned them, don't increase the book. Book started tapering off. And so finally, when the ILFS bubble broke somewhere in 2018 and the real estate financing virtually dried up and the industry was in a bad shape, this company, I think, had one of the least quantum of loan to builders at that point of time. So that was one. And the learning during the ILFS crisis was they had substantial, I think about 24% of the borrowing was short term based on commercial paper and all. So that again was a very tough learning where we had to direct them to reduce that commercial paper borrowing because that was not available afterwards. And so dependency on the short term loans was reduced, more longer term borrowing, more foreign borrowing, maybe at a higher cost at that point of time when this thing happened. And so that was where I think this was one particular company or a group I want to share. Another example I want to share with you, friends, is on a very large entity, about 900 branches. I may say it was a private sector bank, but of course a laid back culture, just like a PSU culture. When I joined the board, the first audit committee I joined, and I observed that there were 55,000 audit commits pending, about 900 branches. I said, where have I landed up? Whether I should resign from this company. But that time, I had more fire in the belly. I said, let's see if we can make a cultural change. And I called the audit head. I said, in case of banks, the number of comments will keep on getting added. The risk-based internal audit, the concurrent audits, the Reserve Bank audits, and so on and so forth. But each quarter, there should be a reduction of 5,000 comments net. And the whole idea was, I told the audit head that you and your people are in the business of banking. You may make mistake. We are not bothered. Only correct it and move ahead. It was a cultural change which was supposed to be brought in so that the people who correct the mistake, they know and they will not make the mistakes again. And if they are malafide, we'll take action. But malafide issues were hardly 1 or 2%, not more than that. And so that was, and I can share with you, I joined that particular board in June 11, 900 branches that time. And I sort of retired from that board after 8 years of being on the board in June 19. The number of branches had gone to 1,200 and the number of comments had gone down to 3,000, from 55,000 to 3,000. But the idea was cultural change. You do business, you may make mistakes, that is bona fide mistakes, but correct it and move ahead. Same place, same entity. What I observed was when I joined the board, superb notes used to come from the people down the line. Very good English, but almost everything was roundabout. No direct response to the audit queries. English is a language. You would have seen Yes Minister also, how we can play with the language. And it was a task, maybe for a few quarters, maybe a year or so, just to keep on pushing the management that we don't want this roundabout note straight. This is the issue. We want a direct response thereon. We don't want a roundabout way. So that was another, facet which I wanted to share with you. Third, one other experience here, every quarter, there used to be a note put up to the board, to the audit committee and the board on the KYC AML, anti-money laundering compliance. So there used to be a note saying that 99% of the operating accounts are compliant. On the dormant and the inoperating accounts, 65, 85% are compliant and the KYC is done, etc. So generally, as an auditor's friend, as chartered accounts, you got a sixth sense. After a few quarters, I just requested the management that I trust you, but just get an outside, firm to review all your KYC, AML, practices, and if any suggestions, implement it. So they sort of put a mid-sized firm where the headquarters were. The firm did a good job. A lot of suggestions came in. We started working on the suggestions and correcting whatever was pointed out. Suddenly, the Cobra Post happened. Cobra Post was a scoop by Tehelka. It was which they came out that the north-based branches of many of the private sector banks was mis-selling insurance to their clients. And Reserve Bank came down heavily. They inspected all the private banks, and the bank where I was, that also was examined, and huge penalties levied. And RBI came out with 8 to 10 observations, which again the management said we are reviewing somewhere in July, August of that particular year. The management came back that, and we had to give the compliance to the bank by say March. So the feedback which came to the audit committee was that we'll do certain things by February. The question is the audit committee to give them a pushback that at the branch level the correction has to happen quickly. Why should you take 6-8 months for the correction? So do it within a month's time, and let's give our feedback to the Reserve Bank earlier than the deadline given by them. So that was, sort of the second matter on the KYC AML, which RBI had pointed out even after their own, study. But friends, you will be surprised. Come April of next year, the audit committee got a shock of its life when the statutory auditors pointed out at that point of time that in the PAN number, any alphanumeric can be put in, typically that 4 alphabets and 4 numeric, and then again an alphabet which comes in. And it need not be necessarily, if it is Nilesh Vikamsi, they can put any crap of, PAN number in that. It need not be mine. So finally, the audit committee, I would say, blew the fuse. I think we were very angry. We said we had started something with our own, sort of, I would say, intuition. We got some suggestions from the mid-sized firm. Reserve Bank has levied such a heavy penalty on us because of that Tehelka thing, the Cobra Post which just came up. And this is the third, the auditors are, even after so many things, Diya Tale Andhera, you call, there's darkness below the lamp. So we fired the management left, right, and center. We told them that you please come out holistically. What are the issues? A very old bank, 60, 70-year-old bank at that time. So there were challenges in the case. We said, you come out holistically, we'll give you time to rectify it. So one is a patchwork, response to issues, and one is a holistic compliance. So that's another trait, I think, which we need to learn of whenever any response comes as a director. So you will be surprised, friends. The management itself came out with a list of 15, 20-point weaknesses in the KYC AML. And again, you'll be surprised that at the audit committee level, for some matters, we had to give them time for 1.5, 2 years just to solve that matter. So this is another, a facet as a director which came in, where something you started on your own, Reserve Bank, this thing slap, and then the auditors pointing out something, and how you had to sort of handle a particular situation. Another, again, situation there, the board requested me as a chartered accountant to look at a quick mortality case. I joined the board in June 11, somewhere in September 11. I saw that particular file, and I sort of told the board that this is, we don't have the right skill sets for appraisal or for monitoring, and we should not do corporate lending. So the board heeded my advice, and the management also heeded the advice, and we stopped corporate lending, and the focus was on retail SME. But as you know, doing only retail SME with the old repayments coming up, the balance sheet didn't grow. So every quarter, we used to discuss with the CEO that this was a board managed bank. There was no promoter there. That why don't you, sort of think of taking lateral, people with skills so that we can restart this business with the interest of the bank. And the feedback was that the unions create a great problem. This is a bank in the area where unions could have created a lot of problems. So we gave, because CEO is the finally person who's facing all the other stakeholders. So we used to support him 1 quarter, 2 quarter, 3 quarter. Finally, the board correctly put its foot down that this is essential for the bank. What we are doing is the interest of the bank. If it is lateral hire is requiring in corporate credit. So you go ahead and do it. We directed the CEO, and we are here to back you up. Assuming the unions do some challenge, we are there, and every time we are doing something right for the bank, we should not be afraid of taking any decisions on that case. So after giving a few quarters for him to And then the CEO got some, I would say, strength, and some lateral hires were made from the industry who were knowledgeable as far as these areas were concerned, corporate finance. And I would say rest is history. The CD ratio had gone down to 68%. It went to 83, 84%, all with AAA customers, which was there. So the board has to put its foot down somewhere where you feel something you're doing in the interest of the company. Yeah, you have to give a rope to the management for some time because they are at the ground level, but where you feel something, is essential. So this again in the same instance, there was one matter where one proposal came, a merger amalgamation proposal, where an NBFC, which was almost the equivalent size of the bank, there was a proposal to merge. But the challenge was the proposal not only merged the NBFC, but its subsidiary. If you put both the NBFC and the subsidiary together, it was much larger than the bank. And we were worried whether it is a reverse, though it is optically a merger within the bank, but whether the control will go. So what we requested to that particular NBFC, that first we merge the smaller subsidiary, and after 2 years we'll merge the larger one, so that we don't get gobbled up as a bank, just on that particular point. But that was not acceptable to that NBFC, and we had to sort of, though it was otherwise interesting merger, and but it had to be, given up. So that type of merger amalgamation proposal came. So that was another practical experience which I want to share with you. And just one more thing, as a chartered accountant, sometimes you have to, not only as a director, to keep on using your connections. Same when I mentioned to you, when we stopped corporate credit and the CD ratio had gone down to say 68%. The same time, I was in the board of another company which was into housing finance, and that company was growing very fast. I didn't have enough capital, and before it could hit the IPO, they had to decide something where their engine, the sourcing engine, was very strong, and they had to hive off certain assets. So I just connected the two without any commercial interest, and about 2,500 crores of the housing finance company loan was taken over by this particular bank, of course, on merit after doing all the due diligences, etc. I think that's another thing which I wanted to sort of draw your attention. Going to a third experience which I had of again a company promoted by a public sector bank, but it had private stakeholders also. When I joined the board, I observed that the employment was being the people who were deputed from the main the bank, and generally they were not of the quality required because this was a very dynamic company growing well, but the employment was a weak area. So we need strong employment in a strong company which is growing, and so they then appointed people from outside, youngsters. We had the requisite new age knowledge as compared to the old traditional way of internal audit, from the risk-based internal audit and all, and that change was made. Another issue, friend, here I talked of crisis management. In the same company, there was an issue where a particular preference issue was, sort of announced, and there were challenges where some of the institutional advisory firm sort of gave that this is not in the interest of the nation, blah, 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 whatever was there. And it was completely legal. The pricing was absolutely as per the law prevalent then, as per the SEBI ICDR, norms, 2 weeks high or 26 or whatever. There's completely only one article of association compliance was not done at the time the proposal came to the board. The moment that was brought to the notice, immediately it was done also within few days. But be that as it may, there was a challenge where the SEBI took strong, exception to that particular matter, despite we doing everything lawfully. At that point in time, the board had no choice but to go to the SEBI appellate tribunal. And unfortunately, again, for the company, there was a split order in the appellate tribunal. It was the presiding officer ordered in favor of the company, and one other member ordered in the favor of SEBI. So there was no clarity on the decision. And SEBI went to Supreme Court. So at the company level, there was a discussion whether we should go ahead with the dispute or what to do in this type of a crisis. Just to prove ourselves right, we could have continued with the dispute because legally we were very strong, but it would have entailed crores and crores of rupees of expenditure, legal expenditure, and plus loss of time. Idea was not to prove a point that legally was correct and all. So we had to take a practical decision and go for a settlement with the SEBI without admitting to any wrongdoing. So settlement was done. So these type of crises also come. That time, I think there's a lot of tension within the board, etc., and the true reflections come out. So this is again an example. One other company which I am on the board was a multinational company, is earlier and now a private equity backed company. Once, friends, one matter came to us which said there was a reconciliation issue where with the American Express Bank, there was a loss of 2-3 crore. The reconciliation was done after a year or two. And I knew, as a matter of fact, that particularly almost all the areas of the activity need reconciliation. The business was such, it was a travel business. And I had to, as an audit committee chair, push the management that I want to review all the whether it's a bank reconciliation, with the vendors, with the suppliers or with the customers or whatever, or with the bank companies, card companies. We brought onto the audit committee and we started focusing thereon. And you'll be surprised because of the sheer volumes. Initially, there was delay. Finally, thanks to the pressure of the audit committee, they started using bots and all. And the pendency was brought down. Even bank dependency was brought down from 6 months to virtually negligible. And a lot of frauds are avoided, because of the reducing the reconciliation time. So these are the areas where you cannot take. It may be the pedigree may be very good of a company. It may be an old company, but there could be issues. And the moment something comes up, you have to look at the larger picture, the helicopter view of what else could be there, and bring that to the audit committee focus. Apart from that, I was in a company where there's a change of management. I joined the board after the new set of promoters came in, and there were old set of promoters. Huge challenges, huge cleanup activity going on. There, what I observed, friends, was many times the proposals used to be put up to the board without enough diligence of the company secretary or the CFO from a compliance or from a regulatory perspective. So one had to give a pushback that the things which comes to the board has to have proper, it cannot be that the matters are just escalated to the audit committee of the board. There has to be enough diligence at the secretarial level or at the CFO level before things are put to the board. So this is another thing which I wanted to share with you. I think that's about it. I think I just want to conclude very quickly on the director's role. I think we need to challenge key assumptions taken. We need to make the management stretch, just not accept. We need to be supportive, but occasionally we can be tough and challenging. We need to offer substance, but not speculation. We need to give connections to the company. We need to add value and drive systemic change. I think some of the examples I gave is how do you drive systemic change within the company, where something comes to you. And one other suggestion from my side is human behavior also very important. Sometimes you need to communicate very tough things, but if you can sugarcoat it, nothing like it. I think like a doctor, if you give a sugar-coated pill, I think that's the best way of getting things done. If you feel that something is not happening and you feel very strongly about it, I would recommend, please get your dissenting view noted in the minutes. Very important. There could be cultural issues also. I don't want to suggest, but what we saw with the Cyrus Mistry and Tata episode, or there could be in the Infosys episode where Vishal Saka came in, that also needs to be reviewed. Friends, related party transactions are the key focus right now, with whether it is SEBI, Ministry of Corporate Affairs. If you are a director, please focus on the RPT, whether they are on arm's length or on, and there are a lot of regulations around this. I don't want to take the time, the separate topic in itself. We need to be careful about the, reputation risk management. We need to be critical as directors that agenda should not be pushed at the last moment. If once or twice is okay if it's something which is done last moment, but many times it's a habit that agenda is pushed at the last moment, the details don't come. I think you need to ensure that, the companies give you agenda in time. And IT, again, information technology is very critical. We may not be experts in that, but we need to have a common sort of a knowledge and sense how to, direct as far as keep on pushing the company to use technology to the core. And some of the don'ts, please don't remain silent in the board meetings or the audit committees or wherever you are. Don't talk throughout the meeting, give others also to a chance. Don't have executive mindset. Assuming you've been an executive in a company and then become an independent director, sometimes our mindset follows us. So don't have that mindset. And don't be critical on a continuous basis. I've seen this again from an experiential sharing. I've seen some people being always critical. I think it has to be positive, suggestive, constructive criticism is okay, but not negative criticism. So when you find things, how do you constructively change things? Is what I wanted to, suggest to you. Thanks a lot for this opportunity. I hope my sharing of experience will help you in whatever roles, whether as an advisor or as a director, you'll be looking out for. Thank you. Thank you, Sripriya. Thank you, Durgesh Bhai. Thank you, Sarega, for this opportunity of sharing my views.
Thank you so much, Nilesh ji. And I've been making furious notes of whatever you said. So, and I'll just like to summarize some things that I found very interesting. I think from whatever you said, it looks like it's actually a bit scary because it looks like the independent directors also at sometimes run the company. I mean, when you spoke about things like reconciliations, I mean, they're so fundamental.
Absolutely.
I think just to summarize, he spoke about the need for professional management. I think that's very important. Risk management, strategy, the ability to offload or even advise to offload a portfolio at the right and relevant time, to be pragmatic to settle litigations. And I think in India, the court processes take inordinately long and it's just not perhaps worth it. I liked this aspect of moving from jargon to reality. I mean, you get board notes and so much of detail, but you just don't know. You only need to be able to shift to identify the wheat from the chaff and just pick what's that. The need to be assertive. I think that's very important. Because I think, obviously, as you said, you're there because there is a job to do. And sometimes I wonder, you spoke about other boards. I mean, I keep wondering what happened in Cafe Coffee Day, for example. It was a fairly monumental and colossal failure, and it's sort of shaken up the country. I mean, I don't know what the lenders and the other exposures are, but when you talk of a number like 3,335 crores, that's quite a bit, and it's a listed company. So reducing fraud risks. Sometimes you realize fraud risks emerge from things as small as reconciliations. So I like the way you connected it. So reconciliation is not just a transactional activity. And some of these building blocks which have been set are very relevant. A big picture appreciation. I think that's something I really liked from what you said. The ability to, sort of look at something much, much larger, managing transition, moving from one entity to another in terms of an M&A, how to use it as a board and support that transition, cultural or even operational. The pushback to fix responsibility to operational management. A lot of us sometimes when we get appointed as directors or independent directors get a little overawed. I think that's something we really liked. The confidence to say, okay, look, I'm here, I know my job and that's why I'm here and there's no fear or favor. Also like that you must come to be supportive and not speculative. Supportive, speculative, constructive. I think those were three very nice things. The ability to drive systemic change. The devil is in the detail and so much more, Nilesh. Thank you so much for being here today. And we look forward to more sessions with you. So now we come to the ultimate part of the presentation today. So I hope we've done, Durgesh Bhai's idea was this to build a template for board oversight. I mean, and after listening to both you and Neeraj speak, we are perhaps going to go back and add more building blocks. So we've built it like a nice mind map. Credit to Durgesh Bhai for actually proposing this, and we've worked on it together. And he said, okay, we'll do it half and half. So he's going to start with this presentation on how you can actually enable board oversight. And I had mentioned before, we're starting with a small illustration of a listed company. And for the rest of the audience here today, who some of whom may not know Shri Durgesh Kabra, he's a chartered accountant, a Central Council member of the Institute of Chartered Accountants of India, also served as chairman of a very large region, which is the Western India Regional Council. So he's in that sense a career elected representative as well. One of his most outstanding accomplishments was to set up the Center for Audit Quality in ICAI, a role that I think he delivered at aplomb. And the audit quality maturity model, the first of its kind, was implemented during his tenure. And I have read it many times now as the deputy convener of the CAQ. And I think all of us must actually go into it. And it's not going to be very long when managements also start asking auditors, what is your AQMM, before they award an engagement. So great job, Durgesh Bhai. And he's the vice chairperson of the Corporate Laws Committee. I'm not so much of a person who can take messages to the market very effectively, something that Durgesh Bhai does very well. And this Manthan was also, he said, let's persist and do this every week. So thank you so much, Durgesh Bhai. And it's over to Durgesh Bhai on his presentation.
Thank you, Shri Priyaji, the chairperson of the committee. the respected past president of the Institute of Chartered Accountant of India, Nilesh Pai, who is friend, philosopher, and guide. We know each other since long back, since 1985, when the first election of Anand Rathiji was taken place. Since then, we know each other. And he has always been a guide to me. As far as today's topic is concerned, I think Sri Priyaji has talked too much about me. The idea was a common idea. When we started talking of the governance, which was thought of Sri Priyaji, but Sri Priyaji does always the good work and give credit to somebody else. Whereas if some bad work is there, she takes the credit. That's the quality of Sri Priya. And that is why she is chairperson. I must tell for her that in last 1 year, she did wonderfully well at the CLCGC, and we could establish a very good relationship with the Ministry of Corporate Affairs. If she represented ICAI in Delhi for 120 days, she went to MCA office for 120 days. And she tried to resolve all the problems with respect to the new website of the MCA V3 version, as well as LLP filings, and setting up of a machinery at our institute who has guided all the people. And as far as LLP forms are concerned, we could settle everything in association with the Ministry of Corporate Affairs, and we could guide them. Even today, our 15 persons are coming under the leadership of Sri Priya, where Sarika is ably guiding everyone, and we are guiding all the chartered accountants, colleagues who are facing the teething problems in filing in the case of V3 version. So it's all credit goes to Sri Priya, who guides continuously to all who are there in the team of Sri Priya. So thank you, Sri Priyaji, for giving me, for accepting me as a vice chair of your committee, and where we are working wonderfully well under your leadership. Now, as far as today's this topic is concerned, board oversight, where we have got a detailed insight from Neeraj Gupta ji as well as Nilesh Vikamsi ji. Neeraj Gupta ji has told about 8 things, and where the directors, board of directors has to perform, and Nilesh Bhai has given the in-depth insight of the practical things as a board member, where he has worked into the various companies, which has been summarized by Sri Priyaji as well, that what exactly is to be taken care by the board of directors. I would like to share the content over here. So I think screen sharing, screen broadcast, Zoom, yes, start broadcast. It's not coming. I think I'm facing some problem here. Sharing this.
Can I share, Durgesh Bhai?
Better. I'm facing some problem here, so I'm not able to. If you can, so I'll stop sharing.
Is the presentation visible?
Yeah.
Please go ahead.
So, effective board oversight, building blocks. The introduction was told by Sri Priyaji. I think you can make it slides. Yeah, thank you. The complete details about the introduction of the subject has been discussed. We can move to the second slide and thereafter the. So what we have thought of today in this is that to have a case study, and case study also of a company which is a very large in the size and which is a non-listed entity from a large business group, a group of a size where the Nilesh Bhai like persons are sitting on the board. So I would say that from large business size, which is having the several investments in the corporate across the diverse sectors. The board of directors wish to be educated on the key elements of the board oversight in relations to their statutory role in the board of directors, which includes independent directors as well as the other directors. So this is what we have thought of, that instead of discussing on the various sections of the Companies Act which are applicable to the board of directors and with the roles and responsibility of the same, we thought of that we must discuss rather the case study, because everybody knows that the section 149 deals with the roles and responsibility of the directors. 166 talks about the various duties of the directors which are to be taken care of by the directors, and 291 deals with the various powers which the board has with them. And let me tell you friends here that Lord Reed in the case of Tesco supermarket versus Netraso has held that a living person has a mind which have knowledge or intention, and he has hands to carry out his intention. A corporation has none of these. It must act through living person. And this has been also said by the Supreme Court. It is important to appoint an individual as a director in the company, as the director's office is the office of trust. And if someone fails to carry out this trust, then someone should be held responsible. So it is very important. This has been dealt trust, transparency by both the Neeraj Gupta ji as well as Shri Nilesh Bhai Vikamse ji, and where the whole board has to work upon. We are discussing today of a case study where this large conglomerate has invested into 75 investing company, and the valuations of the total investment is more than 1,000 crore rupees, out of which it has invested into 14 associate concern, 12 joint ventures, into 4 subsidiaries, and other listed entities which are 12 in the numbers, and some other unlisted 21, and others are 12. So these are the total number of which have been divided into associate, joint venture, subsidiary, other listed, unlisted, or other companies where the company has invested XYZ Limited. Next. So now, here is the responsibility of the board of directors to consider certain key aspects for the purpose of board oversight. And when you have done the investment, when the company has done the investment, the board has to think that why there are no return or low return from the various investing companies, except few where the stellar performances are there, and make the strategy that how the investment starts giving good returns. Understanding the strategy and risk of the investing company, when the investment is done by the company, then the investor company, the XYZ Limited and its board need to understand the strategy of the company, that what company is doing, how they are using the money, what are the risks involved into the business, how the risk will be overcome. So all these things are to be taken care of, and there the again board oversight is needed. Ensuring high governance standards in investing entity. It has been talked about by both the previous speaker Nilesh Bhai as well as Neeraj Gupta ji. If there is no governance or no high governance, then it is very difficult to have the better performance from the investing company. When you are thinking of the high governance in the investing company, it is first that the company who has made the investment should have the better governance. So if you have governance, then automatically you would be having the better governance in the case of the investing companies too, and you would ask them to follow all those things. Management reporting of the key performance indicator is equally important. Whatever key performance KPIs are there with respect to the investing company, the reporting of the same has to be made to the board of directors. Person should be responsible for it, and the action has to be taken on all the reports which have come to the board of directors, wherever the actions are required to be taken. Compliance with the share investment agreement and timely disinvestment decision. This is very, very important. You have invested 1,000 crore rupees, and if you do not comply with the share investment agreement or share purchase agreement, then I think it will be very difficult. When you have to use the put clause, when you have to go for the offer for sale, what are the terms and conditions, whether the investing company is complying with all those things or not. And you have to take the timely decision that when you have to exit from these investments. Then next comes with the timely and complete financial reporting and audit. This is again a very, very important. See, it is equal responsibility of the financial statement preparers. Audit is one part, but financial statement preparers have to be very cautious about this. The board has to see that whatever is being presented in the financial statement are transparent, are compliance of all the accounting standards and various guidance issued by the Institute of Chartered Accountant of India, as well as all the compliances of other regulators which are applicable to the company for the investee as well as for the investor company, and it has to be timely also. One has to see, because in case of the associate and subsidiary and joint ventures, you need to add or consolidate the results. So it is very important that the timely completions of the financial reporting and audit has to be there. So the auditor has also required to be planned. Audit committee should always discuss with the auditors, and accordingly the whole year audit planning should be done with by the auditor in consultation with those charged with the governance and management. So whatever kind of loopholes or lacunas are coming, where they feel that there should be some discussion, the auditor discuss the things at the right time, so reporting can be done at the right time. Otherwise, if everything is done at the last moment, after completing the whole audit, you start discussing the things with the management or with those charged with the governance, I think it will become difficult. So the timely completions of financial reporting and audit is very important. Pending litigations and recoveries is another very important area. You have made investment, you have litigations, you have won the cases, some recovery is to be done, whether you have done it or not. So a list of the pending litigations, how it has to be dealt with, as well as wherever the settlement has done, whether the recovery has been made or not. It is very important, and accordingly, a board has to take decisions where the chartered accountants in all these cases can play a very important role if they are as the independent directors in the board or they are as the consultant to them. Relevant and concise board agenda papers to facilitate actions for approval and oversight. This is very important. Whenever the board meetings are taking place, if you do not have the relevant and concise board agenda, you would not be in a position to deal with all the investment which you have dealt with, that you have made with. And it will be very difficult for all of, for the company to deal with all those things. So how this board oversight can be taken care of? Here, the important things for the board is how to function and what kind of role should be there for the board. It has been discussed by Neeraj Gupta ji also, and has been shared by Nilesh Bhai also, that what should be the role of the board, what should be the role of the independent directors, what should be those 8 characteristics and those 8 areas where the board has to focus. So it is very important that as a governing body of the company, elected by the shareholders in case of a public company, to set a strategy and oversee the management. This is what is the role of the board. And they need to focus more on the strategy and risk management, which has already been explained, operation, internal control, reporting, and compliances. Beside this, 3 more things have been told by Neeraj Gupta ji, and I think those all are important, and those has to be taken care of. Next one. So corporate governance is another area, and this has been a theme of ours at the CLCGC today, and for the whole year, that we focus on corporate governance rather than the compliance with the law, which is for which the various seminars and webinars are being done by all POUs of the institute. So here, the corporate governance is the system of rule, practice, and processes by which a firm is directed and controlled. And corporate governance essentially involves balancing the interests of the companies and many stakeholders. And stakeholders may be the government, may be the shareholders, may be executives, may be customers, may be the other regulators, and the community at large. So corporate governance as a systematic process by companies are very important, and this has to be taken care by the board, that the best of the corporate governance is being established by the board. So when any investor come or anybody thinks to invest in the company, I think you'll get a better chance of getting the investors and attracting the investors. So board's oversight, as was explained by Nilesh Bhai also, that there are various challenges into it when you are dealing with this. So board's oversight is critical to the organization's success and as well as for the shareholders' value maximization. That is not an easy job. Then the what the board ultimately has to look after when board oversight is to be taken care of. So 4 important things, and these 4 blocks are having the multiple things into it. First is strategy and risk. Strategy has to be made by the board and is to be followed, and also the risk management, operation, IT, and HR. Again, very important. Operational part has to be taken care of. What are the IT tools? Information technology support has been taken by the company, whether and into which kind of business they are, and accordingly, IT has to be taken care of by them. HR is again important. The rotation of the people, also as well as the qualified and relevant people are there, and then the policies with respect to HRs, all these are very important. Financial and management reporting, we have already discussed that it is very important. Otherwise, if board doesn't oversee this carefully and doesn't deal with this, I think there can be big losses to the company. And then comes the compliance with all the law of land where you are working, not only of the investing company, but for yourself also, for the XYZ Limited also. So these are very important. And the system of normally of a company is that the board of directors does the oversight on the work which has been delegated to the CEO or senior management persons in the board, because the whole board will not work. There has to be the specified person for specified work and a CEO who does all these activities. And then there is a complete legacy of the working system, and they do the work for the company at large. So there has to be a effective structure for the same, and the company should accordingly follow, and board should accordingly do the oversight. I will stop here, and I would request the chairperson of the CLCGC, Sri Priyaji, to
Thank you.
drive,
Durgesh.
drive from here for the key drivers.
Sure. Thank you. Thank you so much, Durgesh. Sarika, am I both audible and visible?
Yes, yes.
Yes. Thank you so much.
Yes, ma'am.
So, thank you, Durgesh, for setting the context very right. I think what's fundamentally required is corporate governance. Corporate governance recognizes the shareholders as the true owners of a corporation, and the board's role to preserve, protect, and enhance their value. So fundamentally, it's just that. So corporate governance is actually enabled by the board. The board doesn't do everything on its own. It obviously delegates tasks to an operating management, which is why you need to have effective oversight, because it's the board that's ultimately accountable to a shareholder and not necessarily the operating management who reports to them. So it's, and corporate governance is all about trusteeship, transparency, accountability, and control. So the ideal mix is the board must have adequate responsibility, and that should be married with authority. So now, when Durgesh Bhai and I actually worked on this, we figured out that you can't cram too much into this. So there had to be some finite point where we had to cut. So today, if you're talking about ESG, that might not quite feature here, because we said, okay, let's get the basic building blocks. Of course, people, planet, prosperity is all on everybody's mind today. And sometimes I think this ESG is a bit overrated, because we keep talking about buying credits. We keep talking about doing so much of reporting on ESG. How many of us in the organizations that we work have said, okay, let's stop paper cups. Let's figure out a way to do this better. So I for one, also believe that ESG must be more real initiatives, and I think the world is moving towards that. So what are the key drivers? We've put them into some 6 boxes: preliminary, strategy, operations, IT and HR, financial reporting and audit, compliance management, and board meetings. And in this, we have about 22 little matrices, each of which gets explained. I have about 15 minutes. Now, if even we have 5 people who put on chat that you would like a repeat of this session, we'll be very happy to do it for you. 15 minutes may not do great justice to this presentation, but I think it'll be a good eye-opener. But so please do go ahead and put on chat, and Sarika will tell us how many of us wanted a repeat. We could do this repeat very near in the future. So we spoke about XYZ Limited, which is a large company which has got multiple investee entities, 1,000 crores, 75 of them, combination of, as Durgesh Bhai rightly mentioned. Why did we pick this? Because I think this is a pretty common scenario in corporate India. You have a lot of companies which have investee entities, they put money, give loans, etc., etc. So we thought it's important to take an illustration like this. So what is the board's basic expectation? Do I have at least a data matrix of investee entities? Do I have the investment agreements in place? Is there somebody to review the data and information received from investee entities and review of pending litigation? And maybe some part of what we are doing today is also a relic of the learnings from Coffee Day. So it's an interesting NAFRA order. It's a very interesting SEBI order, something that merits actually reading. And I think a lot of what is stated in these orders are very relevant for our clients who may not have multiple investments, but they are invested at least in 4 or 5 companies, let's say. A second, both Neeraj ji and Nilesh bhai stated this very emphatically. A board's role is not just to sit and watch and pass papers. A board's role is to effectively guide strategy. Why? Because it's strategy that maximizes investor returns. Whether it's exploring a blue ocean, whether it's looking at a white space, whether it's looking at new technology, whether it's looking at new products, new lines of business, new services, a decision to go the technology way, strategy would procurement actions. Does a company still want to continue to make paper? Do you think it's sustainable in the long term? Should a company be manufacturing cigarettes? Should they move into other orbits? And I think there's one that's moved significantly into other orbits, for example, ITC. These are strategy actions, understanding the short and the long-term strategy. And typically, as Nilesh bhai mentioned, inputs come from the lower level. It's not that the board sets and everybody follows. You look at the operating management, the CEO, CFO, to come up with what's your strategy and then challenge that strategy. COVID has taught us a huge lesson that nothing is permanent. There's a huge disruption factor that the world suddenly became aware of, much like our Y2K. So how do you run business as usual and on crisis mode? How is information flowing? What's the measurement? What are the risks associated with the strategy? I decide to go into something. Now, is that sustainable? Is that sustainable on all counts? Is it sustainable from a financial perspective, a cost perspective, a social perspective? Operations, IT and HR, right sizing, compensation structures, finding the right man for the right job, optimizing costs, IT and cybersecurity, digital, going the digital transformation way, governance, all this will come under IT, operations and HR. Financial reporting and audit, you'd be very surprised that in many, many companies which have downstream subsidiaries, associates, joint ventures, you can pick a lot of it will say we've prepared the consolidated financial statements without audited financials. I, for one, find it shocking that somebody can't finish their statutory audit before September or before August or before July, or even before June. If you're a listed company and you have subsidiaries, and if your timeline for reporting is, let's say, June, then it's only right that the subsidiaries fall in order and do it before June. Periodic management reporting, Schedule 3 and ICO for compliances, internal audit strategy document. A lot of us might here feel, why is Priya talking about something so fundamental? I also think Durgesh bhai and I did a very, very good reading of several orders, and we found that, all this actually has to be, gotten right. And this is where chartered accountants can actually advise boards. So nobody does internal audit for the love of internal audit. People are expected to do internal audit because it delivers value. So I think that's the spirit of compliance that the country is expecting and MCA is expecting. Compliance management, as Neeraj Gupta ji mentioned, it's changing every day and it's evolving. The latest to join the bandwagon is your audit trails of accounting software. We did the first MANTHAN on this, and it was kind of eye-opening. There's a very simple question. What if a fixed asset register is maintained in Excel? Would you still have to do audit trails? My answer was yes. So the compliance landscape is changing. How do you ensure compliance? So today you have somebody in the board, your friend is in the board or your client is on a board. Somebody comes and says, I have complied with all applicable laws and regulations. Does the board just take it on record saying CFO said, or should the board ask questions? Where is your positive assurance report? How many compliances have you tracked? Next is assessment of litigation and impact. I really liked what Nilesh ji said. Sometimes it doesn't help to prolong, it's better to settle. Board meetings. In fact, we're planning to run a short survey after this, program in the next coming days on how many board of directors feel that their agenda papers are relevant. How many of them feel they are right-sized? How many of them feel they are voluminous? How many of them feel, it helps you to make a decision? More often than ever, you're so bogged down by the 150, 300 pages that you get, you don't know what's the right page to read. So that's the other aspect. And I think these six are very solid building blocks or key drivers of oversight. I have another 10 minutes to go. So I'm going to talk about just the broad themes in each of these. We spoke about investee entities, building a comprehensive matrix, reviewing the share purchase agreement. All these investee companies have taken money from us. They have an obligation to provide information. And I think that's the board's job. The board says, operating management, kindly ensure that you have a monthly reporting pattern. Many cases you will find that the investment agreements were all written, nobody has managed to make it contemporary. You look at the big companies, yes, they've got it right. But investment agreements today that your clients or the boards in which you serve, are the reserved matters clear? Can somebody take 200 crores from you and do as he pleases? Or are you going to ask for board seats? Are you going to tell them these decisions can be made only by me? Today, when there is an investee entity, do I have an exit plan? Is there an IPO? Is there a buyback? Is there a private placement? Otherwise, will the liability fall on the promoter to repay you as an investor? So these are small things that one would want to look at. Strategy and risk, most important, because I think it ultimately your business strategy defines your profitability and your shareholder value. 5-year strategy plans. Some of us might think, oh, Priya's talking about this in a 1,000 crore context. No, I think it's equally relevant in a 100 crore context. Because as Peter Drucker says, every business has to make money, and profit's not really a bad word. So you need to sort of be hard-nosed there. Revenue, costs, and affordable business strategy. I like this word, affordable business strategy. I learned it in my first job, which was at Ford. So at that time, Ford was actually building a factory to make cars in India. And then we would always keep talking about ABS. What was ABS? They said, okay, this is all I can sell. This is how much I can price. So how much should I invest? What should be my cost base? Managing disruptions in a COVID-19 context. Understanding risks associated with strategy. Risks actually tell you how deep or how low you can get at any point in time. I think it's important to understand business risks, market risks, compliance risks, currency risks, credit risks. These are all roles of the board. And in the forthcoming series of Manthans, we will possibly examine each of these elements in detail. So mine is, and what Durgesh Bhai and I have done today is just a curtain raiser. And assuredly, you'd have a top-notch professional presenting to you on this. Operations, IT and HR, hiring plans, compensation structure. How do you procure? And Nilesh Bhai actually rightly mentioned related party transactions, which are always on a scanner. And more importantly, from a point of view of exercising oversight, one needs to look beyond the paper. So that's why you're on the board. You're expected to look at the spirit of the compliance and not just the paper, 3 quotes. And today there's so much data that's available. And again, that's something that Nilesh mentioned, which is data-driven decisions. Quality actions, IT strategies become a big thing today. Security risks, digital initiatives, transformation, migrating systems. These are aspects that the board has to exercise. Significant oversight. So when something happens in a small level, it's called an error. When you have a large error in a platform like an SAP or something, it's called a massacre because the whole thing just goes for a toss. One error in your price masters can actually really make a difference on a particular day. Plan versus performance tracking. How many boards ask for inputs? Typically, there are expected to be presentations by the CFO, the CHRO, the COO. So they all come and present their parts. And The first few meetings are fine, but later on the board must tell them what to present. You lots of times you get carried away by these charts, etc., that one forgets to ask the right questions. Safety and security actions, absolutely paramount. Again, the country woke up to a big jolt when the terror attacks happened. One could actually see the huge change in the way security became to be handled in hotels after that incident. Financial reporting and audit. Many of us would be attending this would be chartered accountants. So what's my Schedule 3? And the most important today is, companies have moved to Ind AS, and this is again something that Durgesh Bhai and I have been speaking about. Why should CFOs of all companies not be chartered accountants? After all, the entire preparation has gone so technical. Entire financial accounting has become so technical in terms of compliance with standards, etc. I think it's time that the country actually woke up. Today, the banks, RBI has mandated bank CFOs to be CAs, but even in terms of a threshold compliance, there is no requirement, but this is something that we're going to ask for. Timely financial reporting, internal audit, audit strategy document, review of statutory internal audit reports. Lots of time the audit committee is held 15 minutes before the board. So if you're on the board, are you going to permit something like that? And again, as Nileshji mentioned, it's a huge fiduciary responsibility. If everything is hunky-dory and happy, there is no problem. But courts look at the role of independent directors fairly seriously. And hence it brings us to another interesting question of compensation, which ought to be commensurate. Timely completion of audits for consolidation purposes. I think it's a lot of comfort dealing with audit qualifications. Compliance. It's like, welcome to this whole new world. Compliance agendas are dominating a lot of our discussions. So much to comply with and so much is changing. Boards ideally shouldn't say, okay, I'm happy you've complied, we'll sign off. No. Must ask for, just like your ICOFER, you need to have a compliance template reporting. Board composition and meeting agenda, very important. We started with XYZ, so let's talk about nominee directors. Do you have the right to have nominee directors on the board? How do you educate nominee directors? You educate them through this PPT. You tell them, boss, keep your ears open. Your nominee director has to know her roles and responsibilities when she's participating in board meetings. It's whether it's an entity without downstream investments or with, timely conduct of board meetings is very relevant. Comprehensive agenda documents. And with that, ladies and gentlemen, I bring you to my last slide. What's a typical board agenda document that one sitting on a board must expect? Any changes to delegation of authority. Why? Because you're delegating authority to an operating management, and if there are going to be changes, you need to know about it. Standard operating procedures, because under the board's overall delegation, this is how the operating management is expected to conduct its business. Any changes to the SOP? And constant revision of the SOPs as well. Significant changes in business or compliance landscape needs to be a board reporting item. On strategy, risk and compliance, once a year, the overall plan, the business plan for the year, the Albatross spreadsheet that shows you everything, where you're going to land up. Risk assessment, compliance reporting. Sales, HR and operations update. What are the critical items? Who's quit the company? Who's joined NU? In fact, some of these are very interconnected. If you look at that RBI Master Circular on frauds, one of the most prominent lines is attrition of key management personnel. So if you're sitting on a board where, every 6 months there's a change in the sales head or operations head or finance head, you pretty much know there's a problem. There's also the role of the NRC there, but I'm parking that aside. Information technology, IT policies, strategy and risk assessments, digital initiatives. Today, the word is to go digital. Management reporting. Every time there is a board meeting, there must be budgets versus actuals. There must be risks to the budget. There must be opportunities to the budget. So this year, if in the beginning of the year, somebody told you we're going to net at 50 crore profit, the operating management has a responsibility to deliver that 50 crore profit, which means you need to constantly tweak the way you're doing business, improve sales, reduce costs to hit your numbers. Audit status trackers, reserved matters, matters which can be decided only by the nominee directors. So somebody says, I want to do a capex 25 crores. It has to be approved by the nominee director, who needs to be empowered. Engagement of professionals, very, very interesting and relevant. But that's something the board doesn't have to approve, the board needs to know. And if I was on a board, I'd be very interested to know who's the legal professional, who's the audit professional who's getting appointed, who are the consultants, is the BCG coming in, is the McKinsey coming in, is a large firm coming in. Exceptions to delegation of authority. So there's a protocol that says so much value has to come to the board, but then there's a business exigency. So we've decided to increase the credit days for customers that has to come back. Pending litigations, financial reporting and audit, financial statements for approval, audit qualifications, board remarks, auditor representations. Now, a very small part of all this, I mean, and I know we love this because it's the Companies Act, Section 135. 135 is a very small part that describes the role of a board, but nevertheless very important. Compliance with accounting standards, selection of accounting policies, going concern. Somewhere after ILFS happened, I think a lot of things changed. So it's not just solvency and going concern, but today, your financial reporting and your auditors are as much, and your managements are as much concerned about liquidity. In case of a listed company, of course, internal financial controls need to be declared by the directors. But what I found the most interesting was clause F. And a clause that's complied more in letter than in spirit. And this is something that I'd like to emphasize towards the end of this program. So the boards are required to virtually sign off saying you have devised proper systems to ensure compliance with the provisions of all applicable laws. And such systems were adequate and operating effectively, which means you need to have a reporting framework on compliance. Now, why compliance? See, on all other aspects such as sales, purchases, etc., you're only sitting on the board. But here is something where you're expected to track, monitor, and deliver this compliance for the country. The other very significant item that Nilesh Bhai mentioned was the UPSI, the unpublished price-sensitive information. So these are some of the key safeguards. So with this, I'd like to bring you to an end of this presentation, and thank you so much for participating here. Yeah, so I'm sure it was a bit rushed. And Sarika, do we have any chats wanting for a larger elaboration? Then we can go in for another.
Yes, ma'am. There are few who wants this session again.
Sure. So we'll do that because I felt, we were a bit crunched on time, but don't worry. Not only will we do this session before we start the next element of board oversight, we'll run this presentation for another 20 minutes. And then we'll go on to that. We'll certainly work that out. So, and thank you so much to Nileshji for actually having stayed back through this entire day. We didn't expect it. So thank you so much. And thank you so much, Sarika, for taking this effort in organizing it. And nice to see you on screen. So could I please request, are there any big questions, or again, I think we're running out of time, so we can push the questions to the next session.
We can push the questions, but one question is that whether the board has to focus only on the compliances.
So that is a question
No.
I will leave for Nileshji. So we'll look forward to concluding this.
No, I think the person has asked very rightly. Unfortunately, what is happening is there's so much compliance which needs to be done that unfortunately, a lot of time of the board gets into compliance. But I think that's the bare minimum. I think we need to focus on strategy. We need to focus on different, aspects like the way Sripriya also did the case study of the investee companies, of HR, of NRC, assuming something is so. There are a lot of other things in the company, which and more the strategic, vision, and how does the company grow, and especially in today's very rapidly changing times, the way businesses are getting disrupted, whether it's technology, whether it's cybersecurity, a lot of areas which may not be so regulatorily essential, even ESG, maybe voluntary, but I think there are 100 other things which we need to look at, and so compliance is I think the bare minimum, and much more needs to be done by the board. That's the answer to that question.
Thank you so much. And thanks to each one of the 850 participants of this session here today. It's unstructured CP, Nileshji, and which makes it all the more valuable because I think there's a lot of audience interest. It's over to Durgesh Kabraji for the vote of thanks.
I think they are really interested. That's why they have gone.
Yeah,
Absolutely.
the real interested persons are there. So thank you, Nilesh Bhai and Neeraj Gupta ji, for being part of this discussion today on the board oversight and value additions. That was very important, and I'm sure that the discussion we started under the leadership of Sri Priya with respect to the corporate governance is going to get momentum. 850 participants without CP continuously watching this and trying to understand. They are the serious people to help the board, that how the challenges of the board can be met out and how the performance of the board can be improved upon. So they have heard together today all these things. And as you said, Sri Priya, Madam, that it is a beginning. And whatever wherever the board has to have the oversight, each subject will be dealt in detail with the different set of the expert who are already there on the board, who are chartered accountant, and how the chartered accountants can add value. I think that would make it more effective. It will give the better learning to all the consultants who are the chartered accountants and other professionals, and even to all the members who are the members of the board. So I think this was a wonderful deliberation today, started by you and led by Neeraj Gupta ji and Nilesh Bhai, where Nilesh Bhai has shared his practical experience of being on the board of various companies, starting from the Indian conglomerates to the multinationals, banks and financial institutions, where the financial institutions are there also into the other activities too. So I think it was very, very wonderful. So thanks to Nilesh Bhai, thanks to Neeraj Gupta ji in absentia, thanks to Sri Priya ji, the chairperson who started this wonderful initiative of MANTHAN series and more on the corporate governance. And thanks to Sarika also for doing all the best efforts from the back end of the CLCJC. And thanks to all 850 plus participants who have listened all the speakers today very carefully. And we assure you that these kind of programs will be repeated, as well as we'll come out with the detailed deliberations on the various issues raised today with respect to the board oversight. Thank you all. Thank you one and all. Thank you very much.
And our sharp secretary clarifies that it was 900. So thank you so much. I just got a message. So thank you so much, Sarika. Splendid. Thank you. Thank you, Nilesh.
Thank you.